Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to the podcast today. I'm really excited for our conversation with Meidad Sharon, who is the founder and CEO at ChargeAfter, a fintech buy now, pay later company. And we're going to talk about his journey into the space, as well as a broader market overview and company overview of what's going on, especially given all of the dynamics that are happening in the space today. So with that, Meidad, welcome to the podcast.
Thank you, Lex. Thank you for having me. Really happy to be here.
So let's start from the beginning. It takes a long time and a lot of experience to get to a place where you can start a company, become a founder, raise dozens of millions of dollars and have it work. But before you get there, can you talk about what are the different experiences and skill sets and components that you got earlier on in your career? Like, where did you start?
I started in a management consulting firm, which I think is giving you it's a great start to the career, since you learn how to think strategically, to look on market dynamics and translating them to strategy. Then I moved into the mobile space, and from there I moved to the payment space. And being in the payment space basically brought the idea and the need to create ChargeAfter. But going back to your questions in terms of what skill set needed for a founder, certainly the ability to think strategically. Sales or business experience is always important when you are founding a company, but also with the ability to identify and go deep into technical problems and understand the technology, since we are in the high tech, right? We are building businesses in the high tech area. So I would say strategic capabilities, the ability to understand business and business dynamics and to convince people with your idea and to understand technology. All the combination of the three.
Let's boil it down to even the basics. What is strategy? We talk about strategic consulting or, having a view on the market. Just what is strategy to you? When you learned this skill set, what did it mean to you to learn it?
Strategy, I think it's first and foremost to be able to see the bigger trends, right? To see the main things out of a lot of noise that exists both internally and externally. To understand where are your main strengths, what core capabilities you have that you can use, where are the opportunities in the market, but also where are the threats in the market. And obviously, so both analyze internally and externally strengths and weaknesses, opportunities and threats, and from that, create the right strategy, looking at different scenarios that can happen in the market and few strategic alternatives. Essentially, this is strategy.
How is this something that you learn? By what process did you learn to be a more strategic thinker?
Yeah, so I think that jumping from college to management consulting is giving you a great experience in seeing how leadership team are thinking, how strategic process within different companies is being done. With learning the methodology, you also see how companies are forming their strategy, how they are analyzing their strengths and weaknesses, how they are analyzing the environment. In many cases, in management consulting companies, you are analyzing the environment for them. You are guiding them through the methodological process of creating the strategy. I think that there is no better way when you start your career to learn strategy than being in a management consulting firm. Later on, it is really interesting, and this is what happened to me when you are starting to get into companies that are actually building stuff, and you see the difference between looking things from the outside to the inside. So this is how you learn strategy, both from the outside seeing both the processes and how to analyze stuff, and then from the inside, what are the real challenges of companies and how things are being done from the internal.
For me, one of the key things that the management consulting skill set teaches you to do is to take a problem and very rapidly break it down into component parts, and to take something that's qualitative or maybe framed as an open question and build an answer out of components and be able to decompose sort of a nebulous animal into its machine parts, and then be able to play with the different variables and understand which ones are going to be drivers, business drivers, and which ones are, just kind of vanity metrics and so on. And it's a very analytical skill set. And as you mentioned, the next roles in your career were in marketing and sales and, basically running go-to-market motions for software companies. Can you talk a little bit more about the difference between the analytical top-down sort of analyst approach and then the pressures and requirements of operating a go-to-market organization inside of a company? Like, how was that switch for you?
Sure. First, I want to say that you're completely correct. One of the questions that were used in the management consulting firm that I have been with in order to, when we were interviewing new candidates, is how much paint do you need in order to paint an airplane, right? How do you take this very general question and you model it exactly as you said? What are the drivers? What needs to be done? How do you analyze it? And this is exactly how you deal with strategy as well. How you model a market? What are the main drivers? What will move things to the right directions? And the development from being analytical in the management consulting firm to going into the more business side, go to market, etc., was really interesting for me. In a way, this was the experience of taking the models that I've built before with all those drivers of what will work in the market, what are the main drivers, how you do pricing, how do you gain customers, which customers do you need to focus on, which are all part of strategy, and you bring them into motion and you see them in the reality. Connecting the direct feedback from customers to the models is, to me, is the key of success in business. How you merge elements like relationship building with more analytical things like focusing on the right go-to-market strategy. Which segment do you focus on? What is the value proposition? What is the key success factors? Who is the ideal customer profile? All of those things, connecting them to the high-level model is what made me successful in the development from strategy to go-to-market and businesses.
The last thread I want to pull into here is you've got the strategic skill set, you've got kind of an operating go-to-market lean, and then, of course, a focus on fintech and payments and e-commerce that starts to bring in industry substance and an industry foundation for someone to be a successful entrepreneur. So can you talk a little bit about how you went into, what is now fintech as a broad category, but maybe your experience at SafeCharge and otherwise, like what pulled you towards this industry, and maybe a little bit about the shape of the work that you did there?
So SafeCharge, now Nuvei, was a great experience to me. It was the first time that I moved from strategy to product management and then to actual sales, being in charge on the company revenue. What attracted me about the payment space is that I thought that, within business, you invest a lot in convincing your customers to purchase. And the payments space is kind of the end of the funnel, right? It's the place where if they will be successful, they will purchase. If not, then you lost all the efforts that you invested before. I saw also the potential of how this market will evolve, and really the combination, which is really unique to the fintech space, the combination between technology, business, and regulation, I thought that is really, really exciting. How those three drivers working together, which one is creating opportunities, and how you combine the three of them. Within SafeCharge, I had the opportunity to join the company in an earlier stage when the company wasn't so big, and to grow the company into an IPO, and later on to later stages to becoming an international international provider of one-stop shop to the payments for international companies, being an acquirer and an issuer of Visa and MasterCard. So a great experience, which actually led me to understand the problem that we are solving in ChargeAfter.
I want to spend just a little bit more time around the learnings you had coming out of SafeCharge and seeing the evolution of the customer, right? Because you were there 2010 to 2016, which is this explosive moment in fintech, especially in the payments category and in the lending category. And it was happening at the same time as there was explosive growth in e-commerce and a continued trend shift in the behaviors of people as well as businesses in terms of how they consume and where they sell, where the venues are. I'd love to get a little bit of color from you on, given that you were in this distribution function for the company, like what was the shape of your clients early on? Like who were your clients early on? What were they like? And how did that change over time during the time that you were at the company?
Yeah, so I think that when I joined the company, always the clients were merchants that sold internationally, right? So selling to more than one country, merchants that are selling to more than one country, in many cases globally, all of them, they were all e-commerce merchants. And what happened during the time between 2010 and 2016, two things happened. First, from more of an innovators, this became more of a mainstream. I think that this is what happened to the e-commerce in general. The second thing that happened is that the clients became more sophisticated. If in 2010 it was more about how to process credit cards online, in 2016 it evolved to not only how you process credit cards online, but what package of fraud prevention you are giving to your clients that would prevent fraud attacks that they might experience, and the fraudsters were becoming more sophisticated. How you are dealing not only with pay-in, i.e. to purchase from the company, but also of pay-out, if they needed to pay out their customers or they needed to pay out to their vendors. So things were becoming more sophisticated. How you are dealing not only with credit cards, but also with alternative payment methods. At the time, we were supporting close to 150 alternative payment methods. So it was exciting and really fascinating to see how from I'm offering you credit card processing online, this became much more sophisticated. How am I helping you to fight fraud? How am I helping you to accept payment but also pay to others? How I'm helping you to accept local payment methods, et cetera, et cetera.
What I'm also noticing and trying to draw out is that during this time, you can also start thinking about the distribution problems of online merchants, and when you're plugged into their payment stream, yes, you are at the end of the conversion process, right? They've done all the stuff to get users there, but there are things that you can do to improve the distribution strategy of your customers. And so I feel like, especially today, we're in this recursive loop where a lot of financial services are being sold, but are being aligned or plugged in with the natural kind of intent flow of the customer, as well as the distribution machine of the merchant. I wonder if you noticed that as well, and then how did you connect some of this to ChargeAfter, and where did the business idea come from?
I think that I started to see two very important trends that kind of led to building ChargeAfter. The first one was the power of financing. I had clients asking me about the possibility to offer financing to their clients, installments, revolving line of credit, lease to own. They wanted to use the power of financing in order to increase the conversion. One of the most astonishing statistics that I was exposed to during my time in SafeCharge Nuvai is that only 3% of the consumers that are reaching a website end up buying, only 3%. And the challenge how to make this 3% a bigger number, even 5%, is almost double than 3%. How to make this number bigger is essentially the most important thing to the merchants. If we can, on the payment side, on the financing side, helping them to increase conversion, this is a key thing for them. So I think that this was the first very important trend, how, and this is something that I got from discussions with the customers. What things can help them to increase the conversion, either by reducing false positive, adding financing, and we can elaborate later on the power of financing. But also on the other side is, I think that we started to see back then the power of embedded finance, how things that are in the natural flow of the journey of the consumer are much more successful. How merchants are starting to sell financial services also started to happen during those years. So the combination of embedded finance and the power of merchants selling financial services with the need to financing, those were really important trends that I saw during my time in SafeCharge Nuvei that led me to build ChargeAfter.
And I think those were very much correct in terms of this sort of melding together of, financial product and marketing flow and consumer behavior. And so you started the company in 2016. And what was that experience like? What were some of the very early wins and challenges that you had?
I think that we tried to go to market very fast, as fast as we can in order to get consumers' feedback and merchants' feedback. And obviously, at the beginning, it was a very intense work of building the product, designing the product that will solve the pain that ChargeAfter is solving, and what feedbacks we are getting from our merchants. So the initial period, I think, outside of raising, obviously, the seed round, was very focused about understanding the market needs, both on the consumer level, the merchant level, the lenders, partners, and building the right product that would solve all of them. Afterwards, we were very focused on getting our merchants' feedback and improving the product. And then, after that, and this is something that we are more focused today, is also the distribution to more and more merchants, more and more lenders, more and more financial institutions.
Can you give us a little bit of just a quantitative overview of ChargeAfter? Like, where's the firm at from a funding perspective? How many clients do you have? Maybe volumes, or how do you think about what is your quantitative strategic model of the business in terms of the levers that you're most proud of?
So maybe I will start with what problem ChargeAfter is solving, and I think that this would it will help understand the metrics. So when I was in SafeCharge and Nuvei, right, I heard clients telling me, hey, we understand that financing can be very powerful for us in order to increase the conversion of the consumers, right? Increasing this 3% of Windows shoppers end up buying into higher numbers. And after that, I started to explore what is called today BNPL market, point of sale financing market. And what I saw, and this is actually the pain that ChargeAfter is solving, there are hundreds of lenders out there in the market, from the no names like Affirm, Klarna, the big banks, Citibank, Synchrony Bank, Wells Fargo, etc., to many others. But the challenge is that each lender today is focusing on a very specific financial product, either installments or revolving line of credit or lease to own. Even within the installments, you have the classic BNPL Pay in 4, that is basically payments over 6 weeks to 48 months installments. Installments on your existing credit line in your credit card or independent of that. So there are many financial products. Each one has a good fit to different type of consumers. Each lender is also focusing on a very specific credit box. It might be prime, near prime, or subprime, which means that their approval rate would usually range between 20 and 40%. Or in other words, they would decline 70% of the consumers. And of course, there is the geographical element where the lending business, or BNPL and point of sale financing, is really local business. There is very local regulation. The regulation in each country is different. The databases that you need in order to underwrite customers are different. This leads to a very local lenders in each territory. And when you think about all those aspects, the geographical aspect, the credit spectrum aspect, the product spectrum aspect, you understand that there are great lenders out there, but the market is disconnected. Each lender is solving part of the puzzle, but not all the puzzle. They are solving for prime consumers in the US that prefer installments. They are solving for consumers in Canada that prefer revolving line of credit near prime or prime, etc., etc. And so the need for connectivity, for a complete solution that would give 80% approvals to consumers instead of 30%, that would enable consumer to choose the right financial product for them. And we are all different. One size doesn't fit all. And the ability for a consumer to choose the right financial product is increasing the conversion. And the ability, obviously, to service the consumer in their geography, and not only in one geography. All of those led us to build ChargeAfter, to build a product that would bring the best of each lender. And so the consumer would have much better probability to be approved, and the merchant would have much better solution that is increasing the conversion and the ability of the merchants to increase their revenues. And so what we have built is a platform and a network that connects the BNPL and point-of-sale financing market, that create from this disconnected market a streamlined solution that in real time is finding the best approved offer for the consumer and letting him use this solution on behalf of the merchant. So we are really excited about the process of that. We have three clients to ChargeAfter. We have our lender partners that are very dear to us and very important to us, and they are enabling us to offer all those great lenders to our merchants and consumers. And we are aiming to have by the end of the year, and we are very close to that already, 70 lenders in ChargeAfter network. We have merchants that are using us, and we have big merchants that are using the ChargeAfter system in order to increase the conversion. And we have also, this is a trend from the last 2 years, we have financial institutions, acquirers and issuers that are using ChargeAfter in order to offer buy now, pay later and point-of-sale financing to their merchants. So I think that what is really interesting that since BNPL has become so important, acquirers that were until then focused on payments, but not on point-of-sale financing on BNPL, understood that they want to enter this market because this is becoming really important product and payment options for their consumers and their merchants. But then they also understood that this market is composed from hundreds of lenders worldwide, as I mentioned before, from prime, near prime, subprime, installments, revolving, etc., B2B and B2C, and different geographies. And the need for a platform and a network has become really out there in the market. And so we have a lot of financial institutions today that we serve that are using the community of banks, the network of lenders that we have created in order to offer this product to their clients.
That's super interesting. I'm going to say some of these things back to you to make sure that I understand. So what I hear is, in a sense, from a consumer perspective, from a user perspective, if a user ends up in a shopping cart somewhere and they want financing, they want help with affording a purchase, that person may be in all sorts of different places. They might be of different credit risk, and they might have different behavioral preferences. As you said, some might say installment payments is what I want. It's easy. It's what the Apple product is looking to do, and it's kind of a lot of the tech solution. Or they might want something that looks more like a traditional line of credit because that's for their geography, the more natural sort of mental model for how to afford something big. But regardless, they end up in the shopping cart, and the core problem is they get bounced a really high proportion of the time because they don't fit the parameters or the underwriting model of the particular tech-enabled lender that is integrated into that shopping experience. And so a way to counteract that sort of negative consumer experience or this problem is to do an aggregation layer of all sorts of different lenders of different types. And you're improving the approval rate on the consumer side, but then you're also giving distribution to underwriters on the other side. And I'll put a pin for now into the financial services sort of acquire example. Does that accurately describe kind of the core value proposition?
Exactly. No, I think that you said it in a really nice way and exact. We are helping the consumer to get the best option for him. And again, there are great lenders out there. The lenders are perfect, but they are perfect to a subset of consumers. If you are prime consumers looking for installments and you are entering a merchant that has that, perfect for you. But if you are not, and you are the 70% that won't be accepted because you're not prime, or you are prime but you prefer the flexibility of a revolving line of credit, then you don't have the solution that you need, right? And you will bounce back.
Can you describe some examples of lenders that you're pulling into your network? Like, what's a profile of a partner, if there is one?
Yeah, we are trying, I think, to cover the full spectrum, right? The product spectrum. So we have lenders that are offering installments, card installments. We work with Visa installments as an example. Non-card installments, we work with Zip, we work with Citizen Bank that are offering installments as an example. So all types of installments. We are offering revolving line of credit. Many traditional all the big banks in the US, for example, are offering that. So we work with Synchrony and Wells Fargo and many others that are offering revolving line of credit. We are connected also with leasing companies that are basically enable you as a consumer to lease the product as you are leasing a car almost. So we're working with all the big companies in this area like Progressive, SEMA, and Catapult, and many others. We have business financing as well, so with the ability for businesses to offer financing to their business customers. So really covering the full spectrum. So every customer, consumer first and foremost, but also business, that is buying something from the merchants that we work with will be able to get an offer that is relevant to him, and ideally more than one offer, so he can choose between different options and find the best fit for him.
I can see why a horizontal integration of this, would make sense, right? Because for each individual lender to try to integrate into all of these different places is much more difficult than to integrate into one place and then have access as a network into broad distribution. Can you talk a little bit about the economics of building out something like this? And I think about it after spending some time looking at the tech BNPL players who are playing lots of these games where they use card interchange revenue as a revenue source in order to finance the credit risk on e-commerce and all sorts of tricks where they're finding revenue pools that are not traditional revenue pools. How are you building the business, right? Because obviously each of the underlying lenders expect to make a return on the capital part. How are you thinking about it?
I think that, we are not inventing the business model. What we do essentially is very similar to what Visa and MasterCard did in the payment space many years ago. When you think about, and this will lead me to the business model. When you think about the payment space before Visa and MasterCard, I know that this was quite a lot of years ago, but when the payments market started, right, each issuer was trying to approach the merchants directly and to offer it to those specific merchants. And as a consumer, you needed to have a card from this specific issuer if you wanted to buy something via cards in this specific merchant. And Visa and MasterCard changed all of that, right? They basically said to the merchant, connect once to us via the acquiring bank, and by that you will be connected to a lot of issuers worldwide. I think that Visa today is connected to 60,000 issuers, if I'm not mistaken. We are doing something very similar in the business, in the BNPL and point-of-sale financing space. We are connecting many lenders into our platform and enabling the consumer to get the best fit in real time. As such, as a platform and a network, we are working in a very similar business model like Visa and MasterCard, in the sense that we are charging the lenders what we call a platform fee. That is basically a fee that they are paying in order to use the distribution network that we have built and be connected to the merchants.
They're paying you a platform fee. Does that scale with transactions and volume, or is that more like a SaaS setup?
It is connected to transactions and volume. Yeah, completely.
Let's take it from the consumer side now. One question is, again, just kind of the scale of the usage of the platform and how you're seeing adoption and how you're seeing people on ramp, transactions on ramp. And I think a related question to that is also, how you're working through integrations and into what you're integrating your solution. So maybe we bundle those two things together, which is, as a distributor of this stuff, are you plugging into e-commerce packages? Like, what is that motion like? And then what are the results of that in terms of the footprint you're starting to establish?
So first, we are tightly integrated to all the leading shopping carts. We have plugins to all of them. So we make it really easy for e-commerce merchants to use our solution. They basically just need to download the plugin, Shopify, Magento, WooCommerce, BigCommerce, etc., and they can use our solution with all the lenders that are integrated to that. So we make it really easy for the merchants. We are also making it really easy for the consumer, since in one streamlined flow, they are putting their data once, and we are matching them with the best lender that is available within this merchant and within our network. So we are tightly integrated to both, and as part of that, we are dealing with many technical issues that are part of the integration, also with making sure that compliance-wise, we are giving the right solution to the consumer that is fair and complying with all the regulation that exists in the BNPL and point-of-sale financing market.
This is a naive question, but I'm curious anyway. Like, how performant does your matching engine have to be, right? Because I imagine there's going to be a really high volume of transactions, but you're matching people against sort of like a live database of lending offers in real time. Like, what does the technical architecture look like?
So the system is composed from microservices, and we have a few patents on how we are doing this matching process. It is highly scalable. As you mentioned, that a lot of transactions or requests to the system are happening in real time, and we are doing load tests, every few months to make sure that we can support the growth that we have and all the big clients that we are adding into the system, either financial institutions that are leveraging the rails that we have built and the connectivity to the lenders, or big merchants that are using the platform. So it's all built from top-notch technology, microservices, and all the advanced architecture. It is also very secured, right? We are remembering all the time that we are dealing with the most sensitive data that the consumer would have, right? In the US, SSN and card data and all the PII data. So we are also investing a lot in terms of the architecture of the system in protecting the consumer data in all sorts of ways.
One last question I want to ask you is around consumer spending and what kinds of trends you are seeing in terms of maybe not necessarily e-commerce, but the behaviors of people and shopping during the current market environment. And so, the premise is, of course, within the context of a coming recession and higher interest rates from the Fed and inflation, the narrative is that discretionary spending for people is way down. And so, you'd expect changes in consumer behavior throughout shopping. And I'm curious what impact that has, certainly on your business, but also, like, do people borrow more when they're able to spend less? Like, what are some of the insights you would have about the credit cycle and the impact on payments and on BNPL as an industry?
I will start by saying that we don't see substantial impacts on consumer behaviors yet, right? I think that the crisis is today more on the capital markets, starting to impact merchant spending, more on the B2B side, less on the consumer side yet. But we Based on former credit cycles, we more or less know what is going to happen if this will evolve further. And I think that what we will see are two mega trends. First, the demand for credit will increase, right? The consumer will need credit more in order to overcome challenges that they might have in work or in anywhere else. So the credit will be much more needed from the consumer side, but the supply of credit from the other side will be much more challenging. Lenders in an environment of an economic crisis or a negative credit cycle will tighten up their underwriting. They might cut it by half. And so the demand will be higher, but the supply lower. Not only that the lenders will tighten up their underwriting, we will see, and we saw it in the past, some lenders will go out of the market. Some lenders, because of the increase in default rates, some of them won't survive this credit cycle. So those are the mega trends that we are expecting to see. We saw them slightly at the beginning of COVID. I think that when the government started to subsidize the unemployed citizens, then those trends stopped. But at the beginning of COVID, we saw exactly that. Some lenders are no longer in the market. Other lenders tighten up their underwriting, cut their approvals by 50% in very short time, in a day. And we expect to see the same mega trends of higher demand to credit and shorter supply of credit. Within that, I think that ChargeAfter has a very important role. As a marketplace and a platform, we help to streamline the connection between demand to credit to supply of credit. By being connected to, as a merchant, to more than one lender, you are able to support your customers, your consumers and business customers, if you have so, with the right BNPL and point-of-sale financing propositions that will first approve this customer and will give him valid options. And B, if a specific lender is going out of the market, then you want to have redundancy. From the consumer side, I think that in times of such challenges, you want to make sure that you are getting the best rate possible. And part of what the system is doing is that it is assuring you as a consumer that you are getting the best offer available. If you are a prime customer, you will get a prime offer. If you are less than prime, you might get higher interest rates that will reflect your risk rate or your risk situation, but always it will be the best that you can get. So I think that we are within such an economical cycle. ChargeAfter as a network and a platform that, by the way, is not lending money to anyone, right? We are not exposed to all of that. We are the technological interface between the lenders and the merchants and the consumers. We have a very important role of helping the consumers and the merchants to overcome this period of time.
It's a really interesting play, and there are really good analogies with the payment space, as you mentioned. So we're definitely watching what you're doing with curiosity and admiration. Meidad, thank you so much for coming onto the podcast today. If we want our audience to learn more, where should they go? Where can they find you, and where can they find ChargeAfter?
So they can find me on my LinkedIn. I'm usually answering any questions that I'm getting from merchants, business partners, lenders. Happy to answer any follow-up questions via my LinkedIn profile. And to the company, just go to ChargeAfter.com and we have contact us over there, and we would love to speak with you further if you are a financial institution or a merchant or a lender that want to join the network. We are here to speak with you and see how we can help you.
Cool. Thank you so much again for joining the podcast.
Thank you for having me, Lex.
Hi, everyone. That's it for this week's episode of the Fintech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.